And alternative assets are outside of the box. They're typically hard to find, and you have to look around for them. So there's a scarcity of capital looking to invest in that space. And wherever there's a scarcity of capital, you can potentially generate higher returns because just by nature of supply and demand, a lack of capital looking for that asset class, you can potentially have more buying power and demand a higher price and a better outcome.
Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show to help you unlock your full self-health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and live by design. Subscribe now and join me and get invested in the life you really want. Let's get started. Hi freedom fighters. Are you frustrated with the performance of current traditional investments and you're looking for other high reward investment opportunities? Are you looking for higher growth than traditional investment options are offering? What are the alternatives and are you able to actually access them? Would you love to consider other investment options but you don't know where to look, how to learn, where to start, or who to trust? Do they have potentially high rewards but also high risks? And what are your barriers to entry? In times of increased uncertainty around market conditions, growth rates, rates of return and risk, many investors like you are looking to diversify your portfolios. Yet most investment advice generally skews towards traditional assets. And more of the same may be a mistake if you're seeking bigger returns in the current climate. You may also be thinking that alternative investment options are just for wealthy, sophisticated investors with massive amounts to invest. So you've never seriously considered them as something that you're able to actually invest in. Well, today we're going to turn traditional thinking about alternative investment classes on their head, because as you'll hear from our special guest, the reality is that alternative asset investments are no longer just for the wealthy, but are now exciting opportunities that you've got the potential to take advantage of. To open your eyes to the opportunities to grow your wealth faster with alternative assets, we're joined by Travis Miller, who's just published his great book of the same name. Travis is one of Australia's leading alternative asset managers, and he's the co-founder and CEO of iPartners, a leading alternative asset marketplace with approximately $5 billion in funds under management. In his great new book, he draws upon his decades of finance experience to show you how a few small changes to your investment strategy can help you reap major benefits and higher returns. And here's the real kicker, without taking on more risk, which I'm really looking forward to getting into. Now, I need to stress the usual butt-covering disclaimer at this point that everything we talk about today is just general in nature and doesn't constitute financial advice in any way, shape or form. So before you do anything, you need to seek your own independent legal, financial, taxation and other professional advice that's tailored to your personal circumstances and your risk profile. Now, returning to Travis's book, it explains how new financial technologies and investment platforms are making many high-yield alternative investments easily accessible to investors like yourself, and it shows you how to effectively diversify your portfolio with them. Having had the pleasure of speed reading his book, it's helped me, and no matter where you're at on your investment journey, I know it's going to help you to learn what to look for in an alternative asset, how to assess risk and expected returns, what traps and pitfalls you need to avoid, where to find stability and growth, and how to navigate fees, finances, and the important part of due diligence. In easy to read and understand terms, Grow Your Wealth Faster with Alternative Assets simplifies alternative asset options to empower you to invest in them. It demystifies the various asset classes and shows you why now is a good time to invest in them. From our quick green room discussion, I know that Travis is passionate about improving your access to alternative asset investments and educating you and other everyday investors about a broader range of investment options. So I'm really looking forward to our deep dive conversation today. So welcome and let's get invested, Travis.
Thanks a lot. Appreciate your time.
Looking forward to the chat today, mate. That very timely discussion. So, but before we get into all of that, I'd love for you to just give us a bit of rundown on what you do differently and, as importantly, why you do what you do, Travis.
Yeah, so iPartners is an alternative investment platform, and I think I was probably always destined to work in alternative assets. If my career background and personal background, growing up in a country town and going through the gym industry as a personal trainer and going through an arts degree and then finally getting into finance, it took me a number of years to find out where I wanted to end up. And then ultimately into a fairly traditional banking career across ANZ, UBS, Deutsche Bank. So into investment banking. But even in the banking world, I was a non-traditional type person. I wasn't doing the standard banking. I was doing all the alternative type, asset classes and derivatives and various different things. So, yeah, iPartners came along about 6 years ago, and the opportunity was really about providing investors access to investments that traditionally are only available to the very large investors in Australia. So you just think the large super funds, the large family offices. And I didn't fall into that category personally. And so I wanted to find investments that I thought would be interesting. So that's where it started. iPartners is an investment platform that allows wholesale investors to get access to these alternative assets. So we spend a lot of time finding these investments, doing due diligence on these investments, putting them onto the platform, and then allowing investors to come to the platform, do their own searching around the investments available, download documents, read educational material, get their heads around what's available, and make their own decision whether they want to buy them or not. So we see our role as just making opportunities available. And then during that process, the big thing I come across is the biggest gap in Australia is education. And we do a lot of work within the business producing, flyers, term sheet, one pages, as much education as we can. But at the end of the day, I thought it was quite deficient. So that's where I came about basically writing this book. It takes about a year or so, anyone who's thinking of writing their own book, a year or so to pull it together. All the editing, all the running around and, fixing all your spelling mistakes and correcting everything you did wrong while you're writing it. And there's still things wrong in it, I'm sure, that can be corrected. But I think I got it pretty close by the end. I mean, that's a pretty long introduction, but hopefully I answered the question.
No, it gives us a really good flavour, mate. And something I just want to drill into there that you mentioned, you said that you were sort of drawn to alternative asset investments. Why and what was the interest?
Yeah, I think it was just a little bit outside of the box. So I was familiar with working at UBS, a very strong equities business, and I worked at Deutsche Bank, which is a very strong fixed income business. So I call them the more traditional public market assets. But within those banks, there's other pockets that fall outside of the box, is where I used to work. And then alternative assets are outside of the box. They're typically hard to find. They're not up on a poster. They're not on a sort of a board like an exchange. They're a little bit different. You have to look around for them. So it was interesting for me just intellectually because it was different, but it was also interesting because there's a scarcity of capital looking to invest in that space. And wherever there's a scarcity of capital, you can potentially generate higher returns because just by nature of supply and demand, a lack of capital looking for that asset class, you can potentially have more buying power and demand a higher price and a better outcome. And so that's why alternative assets were interesting just for me to invest in personally. And the co-founder of iPartners, Rob Nankervell, we had the same view. We were high net worth investors. We weren't, super wealthy like family offices, but we had some money to deploy. And we thought, why do the big guys have access to interesting investments and I can't? And that's where the platform comes into play. And I'm now getting access, as our investors at iPartners, to pretty interesting, risk return type trades and investments. So that's sort of what drew me there, was partly personal investing.
Yeah, well, awesome. I'm going to dive into that in a second because I'll get you to unpack your own investment journey so you can get a flavour for that. But before I do that, Travis, can you share with us something unique or interesting about you that you've never shared publicly before, please, mate?
I mean, I started early on. Well, my career started as an arts degree in recreation and fitness. And I actually, was drafted to play AFL in my early days. But during that fitness degree, I actually became a qualified aerobics instructor, which is, in the fitness industry is obviously a core part of the industry. But I never thought, being a semi-professional footballer, I'd also be qualified aerobics instructor and, involved in that industry. But I say that's probably most people who know me through my banking career never knew that I knew how to do the grapevine and aerobics and various things.
There's a visual image of you in a leotard, mate, which is probably not that we want to think too much about, but I appreciate you sharing that. And quite a chasm between the sort of fitness industry and AFL and what you're doing now. So there's obviously been quite a transition.
Yeah, correct. I mean, it's like everyone goes through different phases in their life. In early days, it was all about sport and nothing to do with school. And then, get to that 23, 24, 25 years of age, and you think, well, I want to do something different. And then I went on to do a Master of Finance, an MBA, a Master of Business Law, and various other accreditations, just because, my father was a school teacher for around 40 years, an English teacher in country Victoria in Warragul.
Yep.
So I've always valued, teachers and education. And myself personally, once I sort of started to focus on, building a career, I pretty much have not studied since, and I continue to do so to this day. But last year I completed my CAIA accreditation level 2, not really because it was going to help my career or, do anything for me from an investment perspective, just because I enjoy studying and learning, keeping myself, sharp, up to date with the, most recent trends.
Yeah, it's certainly an important quality that lifelong learner exercise, Travis. It certainly sharpens the sword. But I'd love for you now just to take us through the nitty-gritties of your own personal investment journey in terms of what you did, when and why, what challenges have you overcome, what's worked and what hasn't, and what have been the learnings from all of that, please, mate?
Yeah. I can start in the early days. I don't know if any of the listeners know about a thing called barrier warrants. I can tell you that was one of my, interesting learnings in my early days before I'd actually educated myself on investing. And barrier warrants, like all investments, they're great until they're not. And the idea of the barrier is when it goes against you, you get knocked out and you no longer have an investment. So they're highly leveraged, and when it goes against you, your investment's gone. So I learned very quickly that leverage can work in your favour, it can work against you. And barrier warrants are a very aggressive form of investing. I think they still exist to this day, but they've become, most of the warrant issuers have stepped out of the marketplace now. So I learned that in the equity space.
Yeah.
But my early investing was really in property. The old simply starting to earn an income, looking to take on a property, potentially the benefits of, negative gearing and discount CGT and all those things that get talked about, regularly. So it was started in property. And then that step from property was simple property, just little small property developments.
Yep.
Just think, turning a small block, single place into splitting it half, turning it into, townhouses and, turning a 2-bedder into a 4 or 5. So a couple of those types of things.
Yep.
Moving to rural sort of development. So property was a big play for a while. And then as I got into my fixed income days, Deutsche Bank.
Yep.
Playing through, in that GFC, it was a pretty, it was a bad era for a lot of investors, particularly in equities. But for me, I was played because my work in those days was fixed income. There's some really interesting opportunity in bank capital, and it was called, subordinated debt and tier 2 and tier 1 debt that some investors, may be familiar with. But they were trading at distressed price, but they weren't necessarily distressed assets.
Yeah.
And so it's one of those, there was no buyers, and I was there prepared to be a buyer in that era. And the market in that debt space recovered relatively quickly, and it was quite nice investment sort of outcomes for me. And that was starting to step into that alternative space, and that just accelerated through my time at UBS and now at iPartners. About 70%-ish, depends sort of, the month or time of the year in alternative assets, really. Things like rural assets, debt assets, equity assets, longer dated investments, shorter dated investments. It's all those opportunities. I'm now so close to them. I look at them and compare it to public markets, and I can see the relative value that exists. And I'm not saying there's not opportunity in the public markets, like traditional fixed income deposits are interesting at the moment, and property and various things. I'm just saying there's other assets that are non-traditional that are interesting in a portfolio.
Yeah, interesting. So in your time at iPartners then, have you got skin in the game with the investment opportunities that you're offering others to become part of?
For sure, yeah. So that's been an ethos for myself and, as I said, Rob Nankerville from our early days. It's like you find an investment. If you personally wouldn't invest in it, then you really shouldn't be offering it to your investor base. So that's your first hurdle. Would I buy it? And the answer is, if the answer is yes, it sort of gets through a filter. If the answer is no, then it probably shouldn't be going on the platform, because if you won't buy it, why should anyone else?
Absolutely.
And that's been, our business name, iPartners, came about from that partnering type concept, that you're partnering with other investors to go into a private investment, a bit like a club-based investing approach.
Yeah, I love it. Love it. Well, it certainly ups the ante in relation to the trust factor if you're putting your own cash on the dash when it comes to investments that you're offering to others. And full marks to you on that score, because there aren't too many in the industry that take that actual hard cash approach, mate. So appreciate you sharing that with us, mate. If you look back then on your journey so far, what's been your best and worst investment, and what have you learned from each of those?
I think I touched on a little bit earlier, but I think during the GFC, there's some really interesting debt investments. I have to say they were, probably my best as far as a total return, risk versus return.
Yep.
And then doing the barrier warrants back in my earlier days would fit into my worst investments. Some listed equity investments that I've done early days again without doing too much due diligence. The old trick of listening to a mate that says this is going to perform really well, you should buy some of this. It's nice hanging out with your mates, but not necessarily listening to their investment tips. So, some of those things. I think as I've grown through my investing career, I've focused a lot harder on, documentation, due diligence, forming my own opinions or forming opinions with a tight group of experienced professionals.
Yep.
There's nothing wrong with, taking a view on something with your friends, but sometimes, they're not informed. That's not always useful. Could be fun though.
It could be fun. You might as well go to the races for that sort of stuff.
Well, that sort of stuff, right? Yeah, you may as well go and have a punt to the races.
Yeah, no, totally agree. Well, I'd love for you to share, because another thing that I think is important for investors to understand is that your investment strategy often evolves over time as your knowledge increases, your familiarity and the opportunities come and go. Can you sort of talk to us about what was your initial investment strategy when you started out, and how has this evolved and why as you progressed?
Yeah, so being an ex-banker and quite experienced in credit and asset-backed investing. So as a business, we started with quite a heavy focus on what they call private credit and investing in asset-backed investments. So just think a debt instrument that has an asset sitting behind it.
Yeah.
And if your investment doesn't perform, you can potentially take that asset, sell it to get your money back. So we started out very heavy in that asset-backed space. Since we have evolved, as the opportunities in the markets evolve, to looking at more property-based investments, the property segment's gone through a bit of a cycle, particularly senior secured debt at the moment. The property space I find interesting as far as value. 12 months ago, I didn't see that value.
Yeah.
And then I look at equity at the moment in private markets. Valuations have come off a lot, and there's actually a scarcity of capital playing in that equity space, particularly in private markets. So I more evolve as the cycle evolves to relative value. And I look across all those private market asset classes, but I'll filter what I invest in depending on what is interesting at a point in time. And it is very much driven by a supply of capital. And where I look at the property space in that particular senior secured debt, there was an excess supply of capital. I'm not necessarily saying they were bad investments from a risk perspective, but on the return side, I was probably looking for a more attractive outcome, which I think is starting to appear at the moment as some of that capital stepped away.
Yeah, I totally agree. Yeah. So if you look back on the journey so far personally then, Travis, if you were starting out again, would you invest any differently?
I think I'd take more of a broader approach. So I've been through periods in my investment journey where I've been nearly 100% property or 100% equity. I'd more sit there and say, I'd take more of an asset allocation approach and just be basically more diversified. I know that's a cliche thing to say, to be diversified, but I see the market as you've got public assets and private assets. If I could access private assets easier in the earlier days, I think it would have had a higher allocation. So I think I've been very concentrated at certain times, particularly in early days in my investing. So that's probably the main thing I'd tweak.
Yeah, it's an interesting one though, because if you diversify too early and you've got too little and too many buckets, then it's difficult to achieve any great growth in the asset base, and at the same time, your broad knowledge isn't there. So it's I think it's fairly understandable well, a lot of investors, when they start in one niche, build their knowledge and then expand out. So I've often said that diversification too early could be classed as diversification.
Yeah, I agree, right? So it's easy. Property is an easy one to start with, I think, right? Like the old buy an investment property can be kind of tax efficient, can be relatively straightforward. It's a simple asset class, commoditized documentation. In some respects, it's about where I started. It was a long time ago now, but it was that simple.
Yeah, totally agree. I've had a very similar experience. I started with CFDs and was starting with CFD indexes, which were leveraged 100 to 1. And you mentioned the roller coaster ride with yourself earlier. I had a very similar experience many years ago. But I now want to sort of shift into start talking about alternative assets and then jump into your book in a fair bit of detail. So before I do that, can you sort of set the scene by telling us what are the biggest mistakes that you see investors making generally?
I think not reading documentation in enough detail. I think a lot of investors see a big return or a big coupon or a pretty little marketing flyer. I think where investors got in trouble have been well-marketed products that aren't necessarily good products, but they're very talented, distributed by very talented marketers. So I would say don't get convinced by a big number or a big return or a get rich quick's not probably the right way to describe it, but a big number. Be careful of big numbers. I'm careful of pretty marketing documents. Yeah. I prefer an ugly marketing document that's disclosed, clear and easy to understand and has all the risks up front than a pretty marketing doc. So I guess that's read the doc in detail or get someone to help you to read it in detail.
Yeah, spot on. Absolutely. The sort of glossy mudguard on something that could be dog poo underneath. It happens a fair bit. On the flip side of that then, Travis, what do you believe to be the keys to successful investment and why?
I think one of the things is just the time frame. Yep. The time frame of your investment. You just need to think of your personal circumstances and where you are in your own wealth journey. And just make sure you invest for that time horizon, because whenever you want liquidity, meaning whenever you want your money back, it's normally very hard to get it back, because when markets like GFC or COVID or even the moment, it's a little bit harder. When you want liquidity, it's never there. So just try and invest for your time horizon of your wealth journey.
Yeah, spot on. If you were to sort of sum up what are the qualities and character traits that separate great investors from the rest, what would they be?
One would be patience. I think the good investors, you don't jump. If you've got $1 in your pocket, you don't have to spend it today. Just sit there and have a look around and find, where you should put that dollar and the right time to deploy it. I mean, timings, it can be hard, but you know when it's a bad time to deploy, and you probably know when it's an okay time. So just be patient. And then I guess the flip of your question is you have people that just rush into the next get rich quick scheme. There's a bit of groupthink's going on or someone else is involved in it and it's gone up a lot recently. You think you're about to miss a bit of FOMO going, you're about to miss it. I think it's like if you go to an auction, you miss a house. There's always another one around the corner or down the road or up the hill. So just, be patient.
Yeah, we've certainly seen the outcome of the greed-driven FOMO exercise and the cryptocurrency exercise in recent times.
True.
So it's certainly been a bit of that. But let's sort of jump into your book now, How to Grow Your Wealth Fast with Alternative Assets. So just to kick things off, why did you write it? What are the key messages and who's it best suited to in terms of reading?
Yeah, so I wrote it just from my learnings, really. So I think, as I mentioned earlier, education is important. Yeah. But I wrote it just because I saw the biggest gap to investing in alternative assets in Australia is education. A lot of people don't know what's out there. They don't know where to look for it. And if they find it, they don't really know how to invest in it or access it. So there's books about saying, in reasonably simple terms, this is roughly what the universe is available to you, ways to assess the investments, and the ways to, actually invest. And it's written in a way, I think, that the normal general investor should be able to read it and understand it and get some knowledge. It's not designed to be a university lecture book. There's no fancy equations, or, you're not going to pass your uni degree from reading it. But I think you'll definitely get some knowledge on what's available out there, and be able to start the journey into alternatives. Or if you're a more experienced investor, you'll probably pick up something that's interesting as well.
Yeah, 100% agree. If someone as simple as me can understand it, mate, then you've hit the mark. And I love the way, because the alternative investment arena quite often is so buried in jargon that I think at times is there deliberately to scare people off to make wealth managers and others justify their existence. But I love the way you've sort of broken it down, and where there are terms that people might not be familiar with, you've actually create a little information box that actually breaks that down. So it's a very easy way to get your head around what it all means. Just to sort of drill into that then, and for the definition of those who perhaps aren't familiar with alternative assets, what is an alternative asset in comparison to traditional ones? And at the same time, what are and aren't alternative assets as you see them then, Travis?
So I think the best way to think about alternative assets is everything that they're not. And so, because the universe is so broad. So when I think about traditional assets, I think about traditional listed equities, Australia and offshore.
Yeah.
I think about traditional fixed income, just think bonds, Australia and offshore, and also managed funds in those asset classes.
Yeah.
And then also cash and deposits. To me, that's what I'd call public markets, traditional assets. Everything else in the private markets, I'd call the alternative assets. And that can range from investing in property, debt or equity, lending money to a private company, putting equity in a private company, things like collectibles, investing in agriculture. We could be investing in operating assets, basically the farmland, leasing it back. It's all sorts of stuff that happens in the real world that is not commoditized, but it's absolutely investable, because the large investors in Australia have been investing in these different types of assets for years. It's just that the average or normal investor like me has just not have access to it, because I don't have $10 million to deploy in every investment I do, whereas the big funds do. And that's why platforms like iPartners, the minimum investment's $10,000, and that amount's aggregated, and the investment's quite large once all investors are aggregated, but the access is now there and available. So it's a very diverse world that you can add to your public markets investments.
Yeah, I love it. And we'll drill into some of the criteria around those who may be interested in looking at it shortly. But can you talk to us, just to whet our appetite, about what makes alternative assets so attractive then, Travis?
I think a point I mentioned earlier is just that scarcity of capital. So the investments are hard to find. And at times they can be difficult to pull together and structure. You need certain expertise to do it. But that scarcity of capital element, and at times scarcity of knowledge. And so you need someone to pull that together for you. It's just some of those things generate a risk premium for you. And then that's why I find it interesting, because when I look at, say, public asset-backed securities and private asset-backed securities, the private market to me looks significantly more attractive, because the public market has all the large institutions playing, and the private market only has a few large investors playing and a lot of other types of investors. So it's that scarcity that makes it quite attractive, and that's across majority of the private markets. Where you have that scarcity, there's value.
Yeah, spot on. And I sort of picked up, particularly when I was reading the book, the fact that often the average investor doesn't think about it, but if in alternative investments, if you're locking it in for a longer horizon, then potentially there's a better reward for that with
Sure.
potentially less risk than the traditional assets. Can you expand on that a bit for us?
Yeah, so I think what you're getting at is like they call it illiquidity premium. Like they are, alternative assets can be liquid. If you want your money back in 3 months, 6 months, don't buy alternative assets. So there's these other, people, they call them risk premia. There's different risk premia that can be, sourced from alternative assets. It needs to obviously match your investment time horizon. But the liquidity premium, I think, is an interesting one for an investor who says, I don't need this money for 2 years, or I don't need it for 3 years. And the investment is 3 years. If you can get a premium on that 3-year investment over and above what you get from, rolling 1 month term deposits, then the 3-year investment might make complete sense.
Yeah, totally right. Yeah. Give us a flavour, and again, we're not holding to this and not stitching you down in numbers, but if we compare the sorts of returns from traditional versus what you're talking about, what sort of quantum are we discussing?
If I look at, again, back to public and private markets, asset-backed investments, you're looking at 2 to 3% minimum, greater returns. If I look at the different levels, it can be high as 5%.
Yep.
But it's a reasonable number, and it is because of there's additional risk. Less liquid, can be longer time horizon, can have refinance risk. There's always risk elements that you've got to consider. But when I work through those, I still think the premium is quite attractive over other public market assets.
Yeah, Brian. Now, in the book, you talk about sort of 8 alternative investment asset classes. Can you give us a very quick potted summary of what they are, and then we might drill into a couple of them?
Yeah, so I start with property. When I look at property, it's just, think largely commercial, but it's lots of different aspects of that. But it's equity in property, so you actually own the asset. You got debt, which is you're lending money to the owner of the asset, and you also have property options, where you effectively have the right to purchase an asset, which can be quite interesting as well. Then you have private credit. Private credit I break into 2 buckets. One is lending money to a private company, and then you're effectively getting paid interest and principal over time. Asset-backed lending, we're lending money to a third party that might be buying a truck or a car or a portfolio of assets. So that's the asset-backed lending space. The next one would be agriculture, which is an asset class I really like, where it can be lots of different things. It can be in the operations, so investing alongside a farmer. It can be buying the land. If someone wants to buy the neighbour's property, or you physically buy the land and lease it to someone, or it could be actually funding assets on the property. So you could be funding a farmer to buy cattle or to buy seed, all sorts of different things. Agri is quite an attractive segment. Another one in there is the collectibles, hobbies type, how I put them. I think there's a lot of experts in certain fields where they can generate quite attractive returns from what I call hobbies, which is, cars, watches, paintings, all sorts of things. But I think for the average investor, it's a tough way, to make money if you don't have that expertise, because you often got quite bid offers. It can be a private market. You don't really know where the market is. But if it's a personal interest and you like it, you want to deploy a small amount of money in it, fine. Go ahead, each to their own. And as I said, the experts in the field, I'm sure they make, good money out of it. They're good investments. So I guess they're the main ones I wanted to run across.
Yeah.
I guess if you continue it on, you've got things like infrastructure and obviously private equity as well. Infrastructure is a great asset class. Hard for investors to get exposure to because they are very big assets. Like it's a big bridge or a big tunnel. You often find you take that exposure by listed companies at times.
Yeah, no, good call. So what are the best strategies for success in alternative asset investing then, Travis?
I think it's the key is, I used diversification earlier again, but it's not to put too much into any investment. It's a bit like, because if you go to a platform, you're taking direct exposure to single assets.
Yep.
If you're to buy a fund, you're getting exposure to lots of different assets. So if you start using platforms to take exposure to single project or single assets, you need to be spreading your money across a number of different projects. So I'd be picking different assets, different regions, different maturities, just spreading it across different buckets of risk.
Yeah, okay. Now, in a traditional investment portfolio, most of the normal advisors sort of try and limit your exposure to alternative assets to around sort of 5% or thereabouts. What's your view of that in the context of the opportunities that we're talking about today?
Yeah, like the number I'd target is 20% plus is where I tend to land. I think you've got your public market assets who are what they are, but I think there's a 20% type number. And again, it depends on investors' time horizon, right? Where are they at? How much money they have, wealth they got available. But 20% is a number that I look at as reasonable for most investors, particularly high net worth investors, because it still gives you the 80% of the public markets, which probably give you more liquidity, more traditional exposure. And then you've got your other bucket, which gives you an interesting diversification, maybe a bit of a kicker from a return perspective.
Yeah, no, beautifully said. So let's talk about risk for a minute. What are the pitfalls and risks of investing in alternatives, and how can we limit or mitigate them?
I think one of them, so you got liquidity risk, which you talked about earlier, and now liquidity risk is only a risk if you need liquidity. Stating the obvious, right? But if you don't need liquidity, right, you've got an SMSF, you might have a time horizon of 20 years and it's a 3-year investment. You don't really need liquidity there, do you? So you might say, well, let's take on that illiquidity risk because it's generating return. But depending on the asset class, right? So credit, you take credit risk. Say I lend money to a company, I'm backing that company's profitability can pay my interest, my money back over time. So you need to dig into the detail of what's the EBITDA, profitability, balance sheet, and typical corporate finance assessment. When you're looking at equity, it's quite similar in a way to private credit analysis. What are the management like? Are they capable? Are they experienced? What's their track record? Do I like them? Do I trust them? And do I believe their growth story? So it's very much a lot of corporate finance-like analysis. If it's credit, you're looking from a credit perspective, a little bit more senior. If it's equity, the bottom of the cap structure, you've got to be pretty scrupulous with your analysis of the numbers. And then you jump on the ag space. You've got the weather element to it. You've got the disease element to it. So it depends where you're playing. So there's similar risks that exist in public markets, but in private, there's probably a few more you need to think about, and you need to dig in a little bit more detail because they're often earlier stage businesses and less publicly available data. And so you want to be kicking the tires a fair way up the food chain, meaning, for us, I need to be speaking to the CEO, the CFO, the CIO, because I want to have a fairly high level of detail before I'm, making a call on something.
Yeah, that due diligence that you're talking about, is this something that you and the iPartners team does on behalf of the investors, or is there an expectation that the investors themselves will need to do additional work in that regard?
Yeah, I mean, as an investor, I would you still should do your own due diligence, but something that iPartners does pride itself on is that we are doing a whole series of steps before it gets onto the platform. We mentioned earlier that, if I wouldn't personally buy it, it's not getting past the first step. If I don't like the counterparty I'm dealing with, I don't trust them, I've seen their CV, I don't think they're capable. It's a whole series of steps that we go through that by the time it hits our platform, we think it's very highly vetted. But when I think about a personal investor that doesn't know who iPartners is, you definitely should do your own due diligence. You have a look at what my background is, who's my head of funds management, who's my staff, read the documents, read the risks. Sort of the whole idea of the book in a way is it does talk about iPartners because that's who I work for. But at the end of the day, the business I started, but at the end of the day, it's about investing, and you're going to invest with people other than iPartners. So you got to do the scrutiny.
Yeah, totally. Like you would in any investment as far as that goes, because it does come down to the quality of the people. Essentially, at the end of the day. Yeah. Now, on what basis and criteria should potential investors decide which alternative investment class is best for them, as you see it?
It comes down to the stage of their, the investing stage. So I'll give you an example of what we see, right? So a lot of self-funded retiree investors, they tend to predominantly focus on our yield-based investments that pay monthly distributions. That's a little bit of a proxy for income.
Yeah.
Then we've got sort of the other investors that are more still earning a salary. They've got their SMSF. They don't need income in the short term. They're more likely to look at our equity-based investments for their growth characteristics. And then you've got people in between. And because then some people will say, I'm a little bit risk averse. I don't want to be in equity, I'm happy to take senior secured exposure, because that return of whatever 8 to 10%, it's a bit equity like. It suits my little bit more conservative risk profile, and that's where I want to play.
Yeah, no, well said. So you've touched on this already, but to expand on it a little bit, what are the prerequisites and minimum requirements for investing in alternative assets, Travis?
Yeah, so it is so in the iPartners space, it's wholesale investors only, right? So that's your 250,000 per annum for 2 years, or 2.5 million of net assets. Increasingly, or over time, a lot of these investments will start becoming available to retail investors. At the moment, it is still more of a wholesale investor marketplace, but I think that will definitely shift, because if you think back a number of years, it was really just the big Aussie super funds were investing. In fact, you go back even more years, it was the big US sort of endowment funds were investing, and then the Aussie investors have started copying that strategy to a degree, the large super funds increasing their allocation of alternatives. And then it comes down to family offices, it's come to wholesale investors, and there's no doubt it'll come down to more to retail investors as product providers start looking closer at that segment of the marketplace.
Yeah, awesome. Now, in the book, you step out a sort of a 7-step exercise for finding the best alternative investment trades. Can you give us a quick potted summary of what that looks like?
Yeah, so the starting point I have is just who is the counterparty, who's looking for capital. And it's a vetting process of just looking at their CVs, looking at their background. Do I know them? Does one of my friends know them? Are they experienced in the marketplace? So it's literally, in private market, it's a bit of a gut feel, common sense approach. And you'll meet them, and there'll be some that you just won't get along with, you don't like, so you don't do business with them. And the reason for that logic is sometimes transactions can be long tenor, and you don't want to be stuck in a transaction where you're regularly going to ask for information and you're dealing with someone that's sort of not, you don't want to deal with. So I know that's a little bit of an arbitrary assessment, but that is actually step one.
Yeah.
And the next one is you do basically due diligence, and then it's like the risk return on offer here, does it make sense? Is it similar to other investments I've looked at? Is it better? Is it worse? Do I think I could negotiate a certain outcome? So it's just a scan. So those 2 steps can take, best a couple of hours. Yeah. And then you'll get to the point of going, yep, makes some sense, detailed due diligence. That's when you're getting things like financials and CVs and running bankruptcy checks, all sorts of stuff in the background that you're running.
Yep.
And then once you've gone through that, it goes to the actual commercials of, this is my offer, negotiating a term sheet. And negotiating a term sheet is fun in a way, because you actually want the capital raiser to get a good deal, because you want them to be in business, because if they do well, the investors will do well. So you can't force too hard one side or the other, but you want a good risk return for investors, because that's who I see that I represent. And you want to get terms in that term sheet while you're negotiating that are in the investor's favour if things go wrong. Because you only need a term sheet really when things go wrong, because it gives you some protection. I know it's a long answer. And then basically within iPartners, there'll be an investment committee where all the experienced investors come together and they form a view, is it good or bad? In the private investing world, I'd be trying to find a few friends that are experienced in investing and bouncing ideas off them to get a bit of feedback. Because direct investors, you typically don't have your own investment committee. It's very valuable to have a few friends that you trust, and you can either invest together or bounce ideas off each other, because having more heads involved in the decision-making process is better than just one. And then ultimately we go to final due diligence page process, which is ticking some boxes. So It's really just common sense scrutiny up front, quantitative assessment on the way through, getting a bit of qualitative assessment with a few friends, investment committee from our perspective, and then final box ticking to make sure what the company's told you is factually correct and stands up to scrutiny.
Yeah, no, that's all good common sense. But again, common sense is something that a lot of people don't make time for in the investing world, Travis. But sort of shifting into the opportunity exercise moving forward, if you were looking to invest now in alternative assets, what would you invest in and why, both as either a growth investor or a yield investor? And again, I want to underpin here, this is general information, this is financial advice. So what are your thoughts around where the opportunities are emerging?
So it goes in cycles, but as the thematic of private credit in general, I think still a very good one. There's still a scarcity of knowledge and capital investing in private credit. So iPartners, for example, has a number of private credit funds which have been performing quite well. That segment of the market's still attractive.
Yeah.
What's happened recently is that I think there's been quite a value shift to senior secured debt in the property space.
Yep.
As I think I mentioned earlier, it was saturated. So I think that's a relative value trade that'll play out probably the next 6 months, maybe longer. So I've shifted more to looking at property, whereas I'd be more focused on private credit. So they're both in the credit space.
Yep.
I think profitable private companies, profitable meaning EBITDA positive, that are looking for capital at the moment, I think are quite interesting because there's not a lot of new capital being deployed to private companies.
Yep.
And so I think that's a very interesting space, not without risk. But I think there's some really good companies out there at the moment that are struggling to raise equity capital. And I think if you're someone that can understand their business and have that capital, it's a pretty good time to be deploying. So I think they're a couple of the pieces of the puzzle that I quite like at the moment. But, as markets turn, you ask me in 3 months' time, it'll be something different.
Yeah,
and I think that's how we
understand
think.
that. Yeah, no, absolutely. And it's taking advantage of the right opportunity at the right time. You mentioned earlier on in our chat you like the agri space. Talk to us a little bit more about that because for a lot of listeners, they probably really haven't got their head around.
Yeah. So I'll try and give an example and hopefully it comes across okay. So we as a business have been lending money to a company that lends money ultimately to farmers to buy cattle. And this is actually, sort of fattening cattle that puts on weight. And so the reason I like that sort of cattle is every time it puts on weight, as it obviously grows, the fattening up of that cattle increases the value of the thing. So if you think about, if I lent you some money to buy a car, the car depreciates and goes down in value. If I lent you some money to buy cattle, the cattle is fattening up. And a lot of that fattening up offsets the price of cattle going down, which has been happening lately.
Yeah.
But I like that part of the sector of the market because it's sort of eating the grass or grain and putting on weight, and it's actually quite a nice segment to lend money to. And then if I look at just purely agri land, I think at times it can be a different segment for the banks to get their head around. They look at their traditional lenders. Whereas there's a lot of assets on a farm that maybe a bank wouldn't lend to that I might look at from a private sector and say, that's a good asset. The bank's sort of been very conservative here. Maybe we could lend some money over that asset. So it's more, I know I talk about scarcity of capital a lot, but I think that's for the private market. It's where you can find the value.
100% agree. Yeah, and that scarcity is the key word. So for those that have been listening to this going, this sounds really interesting. Where do we need to start with alternative asset investing and what steps should we take?
Yeah, so I think it's the educational material first. It can be my book or it could be something else that you find out there to educate. I'd probably start in a fund format. What I mean by fund format, I mentioned iPartners had funds. Most of our funds will have 30, 35 assets sitting in them. So there's an initial investment, a small amount in there. You're getting an immediately diversified portfolio. And then the next stage is you might start picking your own investments from a universe of things on the platform. I think that's probably how I'd be thinking about it. Educate, understand what you're buying, look at a diversified fund, and then consider the single assets.
Yeah, I love it. Now, we sort of talked about before, one of the benefits to some degree of alternative assets is that it's a longer time horizon that you're investing. But one of the sort of secondary benefits of your iPartner platform that I picked up is that there's almost a secondary market. If you've got enough people that are buying and selling, and you needed to offload a particular investment earlier than the original horizon, there may well be other investors swimming in your pond that are prepared to pick it up. But can you talk to us a bit about that?
Yeah. So on the iPartner, we're approaching around now 10,000 direct investors. And so they're always looking for different investments. So if someone wanted to sell, we could potentially buy it from that investor and then on-sell it to another investor. And so that's trying to create some liquidity in illiquid markets. And most of the time, it's just when a personal circumstances change. Sometimes people need liquidity, even though they thought it might have been happy to invest longer term. And our platform, our investor base can potentially, via us, facilitate that.
Yeah, no, awesome. Mate, really appreciate you taking us through that. I know you would have whet a lot of appetites to the opportunity that you're presenting in that regard. I want to now switch to the old, what I call the ambush fast four round, where I give you the blindfold and cigarette and hit you up with the questions that we ask. So to kick that off, what's your favourite quote and why?
I don't know if I have a favourite quote, but what I would say, a lot of when I'm talking about is never underestimate yourself. I think a lot of the time, you might be working as a gym instructor, or nothing wrong with being a gym instructor, by the way, but you've got a different career path. Just never underestimate what you can achieve from an investing and career perspective if you just put your mind to it. So that's not really a quote, but it's something I believe in.
Yeah, it's a good credo to operate on, mate. There's no question about that. But if we talk about the literary front, on top of your own book, or separate from your own book, what's the top book that you'd recommend we read and why?
So I read anything from Malcolm Gladwell. So I don't know if you know some of his books, Tipping Point, Blink, Outliers. I just like he's obviously a quirky bloke, and he sort of makes you think about different things and different coincidence, different events. So I think anything he's written is worth reading.
I've read every single one of his books. I listen to his podcast. He just has a different way of looking at the world and describing it in a way that makes absolute perfect sense when you read it, but I wouldn't have thought of it myself.
Yeah, for sure.
I love the way he does that. So that's a great recommendation. Back on the investment space for a minute then, Travis, what's both the worst and the best piece of investment advice that you've ever received?
Best advice was read the fine print. Just read the detail. And the worst advice was to trust them. So that you often get someone who say, "This is great, trust this bloke, he's brilliant, invest with him." I just think when it comes to my money and my investors' money, I will trust them once I get to know them, but I won't trust them before I know them.
That's a very good call. Now, love for you to talk to us about a daily discipline or a happy habit that you employ that you think's contributed most to your investment success today.
Yeah. Mine is I try and get up every day at 4:30, and I do that because your day gets very busy. You get to 7:30, everyone's up and about, and you start getting messages. But I find get up at 4:30, I'll do exercise, I'll do some reading, and I'll catch up on the day before and plan the day today. Just having that 2 hours or so of private time with no disruptions, I found is the best discipline I've had for a number of years.
Yeah, I love it. What time does your head hit the pillow at night then, mate?
Reasonably early. I try and be down by 9:30, 10-ish at the latest. Yeah. You can't do both ends.
No way. Yeah, no question about that. Awesome, mate. Well, look, to summarise our great conversation today, what are your key takeaways and must-do actions for investors who are considering alternative assets?
Number one is simple for me. It's purely education. Spend time, understand the asset class, understand the choices within the asset class before you do anything really. And then start small. If you're going to do an investment, if you're sitting there thinking, I wouldn't mind putting 50,000 in, just put 10 grand, 20 grand, and then see how it performs. Wait a few months. Did it perform? Did it do what it was said on the box?
Yeah, extremely well said. It's again common sense, but there isn't that much common sense around these days. Travis, for those listening who've really resonated with your message, how can listeners find out more and get more involved with you?
The key thing is our website, iPartners.com.au. You can jump on there, have a look around. I think that's probably the starting point. You can track me down on the website too. I'm pretty open-minded, pretty balanced, happy to chat to people you might have picked up from this conversation. So,
love that. Well, look, I know you very generously offered Get Invested listeners a special challenge to get a free copy of your book. So if you're interested in getting a free copy of the book, grow your wealth faster with alternative assets, you just need to email me at bushy@knowhowproperty.com.au with your answer to the question, why is now a great time to consider investing in alternative assets? So I'm going to be checking whether you've listened to the episode to be able to answer that. And for the best answer, we'll send you a free copy. Now, in addition to that, if you're a wholesale investor with a wholesale certificate, you can also score a free copy of Travis's book when you complete iPartners registration onboarding process, again, at iPartners.com.au. So when you register, in the Where Did You Hear About Us section, just select Other and then type in Bushy. So don't delay, do it today and take this action now that your future self is going to thank you for. Now, in closing, I'd really like to thank you for opening your eyes to these great alternative investment opportunities, Travis, and we're looking forward to keeping the conversation going.
Very good. Appreciate your time.
Thanks, Travis. Let's talk again soon.
Thank you.
Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. And don't leave yet until you've taken the next step towards living by design by getting my award-winning book, Get Invested, absolutely free when you sign up at knowhowproperty.com.au or bushymartin.com.au. And finally, make sure you subscribe to Property Hub to get your weekly dose of Get Invested inspiration, along with every episode of Realty Talk, Australia's leading property show for red-hot property investing news and insights, direct from industry leaders and influencers. Remember to always get invested in your knowledge, and I look forward to seeing you next time.